Hey, good morning, Freeman CPA. So today I'm going to talk to everybody about rental real estate and what it means for tax purposes. All right, we got our little quote of the week here. All that we are is the result of what we have thought, and that's by Buddha. So rental real estate is kind of like everybody's dream. Everybody wants to get into the real estate rental game, and actually, I had a post this morning from a friend of mine that just got his first rental and is excited. And I guess he's been waiting for that for a while. And once that happens, there's a few things that you should know about and just get the idea of what a rental activity is. So for tax purposes, rental activities is what we call passive. And what does passive activity mean? It's the opposite of active. And active is something that you would do, for example, for your living, so employment. Is an example of active. So when you're receiving W-2 income or you're receiving income from your business, all right, those are examples of active income. So what's the deal with active and passive, and why is this important to know? Again, rental activity is deemed passive. All right. So let's now take a look at a few other items of importance. So rental real estate equals tax shelter. You might not have realized that, and you're like thinking, oh goody, I'm now gonna have a tax shelter, I'm going to save money. That's a little bit of a smoke and mirrors thing, but yes, rental real estate is a tax shelter. And why is it considered a tax shelter? Well, because you have rental income for, let's say, $1,000, okay? Then you have operating costs of, let's say, $500. Right? So you're going to have profit of $500, but the cost of the property is going to be depreciated over a certain amount of time. And in most cases, it's going to be depreciated over 27.5 years. Okay? So in most cases, the depreciation, which is a non-cash outflow, it is just for tax purposes, okay? It's a deduction, right? Depreciation is a deduction, if you want to call it a deduction. And let's just say that that depreciation amounts to $700 for tax purposes. You now have a tax loss. And this is why rental properties are considered tax shelters. Because the depreciation is going to shelter the tax, and you're not going to be paying income taxes because of this depreciation, but cash flow, it's cash positive. Because you've earned $500. You've pocketed for cash flows $500. So $500 went in your pocket, but for tax purposes, you got a deduction, and you're actually writing off enough to have a loss for tax purposes. All right, so keep this in mind. That's why it's called a tax shelter. Why is it smoke and mirrors? Well, because that depreciation will be recaptured when you sell the property. Okay, so we have three scenarios. We have the middle. This is one. then we have the other one, and then we have one more. Okay, so this is the tax shelter. This is the optimal situation. This is where most people actually end up, where they have the depreciation sheltering the tax, it's making cash flows, everybody's happy. Then we have the positive side, and then we have the negative side. So the positive side will be where your depreciation makes more money, so you're getting that $1,000, right? And even with depreciation of, let's say, minus 200, and you have operating costs of another 100, it's a really great buy, right? So you actually have a $700 profit. And this is going to be taxable, because even after depreciation and operating costs, you're still ending up with taxable income, right? Right there. So that's a really good buy. That's the situation that most people don't encounter. We have clients that end up in this situation, and they bought the property outright. The property was low cost. They did some repairs, and it was in a great location. It was placed next to a university, a technical university, so it's constantly rented out. The people that are renting it are basically good students, because it's a technical university, so they're always paying on time. They're not disruptive, they're quiet people, there's no parties going on, so there's really no issues with the rental, and it's just a great investment. It actually it makes enough to actually make taxable income. Then you have what we call the money pit. Now, a really great example of this is when clients that buy a property and just keep dumping money into it. So they're making $1,000 a month or what have you, and then depreciation is like $800 because the property was expensive, and then operating costs is another $800. All right, and what's ending up happening is you're actually losing $600 per month, right? So depreciation expense, and you have operating costs. So this is not a good deal. This is the money pit. It's just a loss no matter what. But it might have other sentimental value. It might have other value to the client. A great example is one of our clients has a property down in the Key West, and the land is super valuable. It's like $1 million. Okay, so this is going to be a retirement piece. So it's rented 2-3 months out of the year, because Key West has rental limitations. You can only rent out 2 or 3 months, and it's making a decent amount of money in those 2-3 months, but then it sits around idle the rest of the year, and the costs to maintain it are really high. They're astronomical, because the taxes there are high, and the costs to maintain are high, and then there's hurricanes that come around every so often and cause a lot of damage, and then they have to rebuild. So they're just constantly dumping money into it, but it's valuable, and they're going to use it for their retirement. So they don't really care that it's a money pit, but that's not everybody, right? Some people do really care about it. It was just a bad deal to begin with. So in that case, so that's basically the 3 types of scenarios we see with rental properties. All right, now let's talk about losses. So now that we understand a little bit about how rental real estate works for tax purposes and depreciation and everything else, now let's just talk about what it means for your taxes. All right, so here we are at age 25. All right, we're making let's say $75K, and here we are in age 40, and now we're making $200K, and somewhere down here we're in age 35. All right, so what's going on, right? Why is this important? Well, when you're renting property and you're young, you have rental real estate, and you got that medium, you got that tax shelter going on, and it's producing tax losses. You're actually getting some cash flows. This is a good time in your life. You're starting to build up your life. You're getting to that accumulation of wealth phase in your life. And That's basically every year you're going to file your taxes. Now, remember I said you're making 75K on a W-2, and that's active income. So what's happening in this situation? So as you're getting this active income, the rental real estate is producing passive losses, right? So you're making the 75K and you're getting passive losses from the rental real estate. So here's that 75K, and let's say you have passive losses of $10,000, right? Now you just shaved off of your W-2 10K, and you just saved yourself some in taxes. Great. Because now let's start. Why is this allowed? Well, because there's what we call a mom and pop exclusion. Because you're not allowed to offset the passive laws, the passive activity loss rules state that you're not allowed to offset passive losses from active income. But you get to do that under the mom and pop exclusion, up to 25K. So had this been 26K instead of 10,000 in losses, you would have only been able to take 25K unless there's another exclusion. So this is exclusion number 1. And exclusion number 2, you're a real estate professional. And I'm not going to go into what a real estate professional is and how many hours you need and what you need to be doing, but it's basically your livelihood. Okay, you're doing real estate for your living, and that would be the second exclusion. So if you did lose 20, let's say 30,000, right? If your losses were 30,000, you would only be able to use 25 to offset that 75, unless you are a real estate professional. So that's how passive activity loss rules work, as long as your income is below 150,000. That's the other limitation. So that's basically, in a nutshell, what's happening. So as this person is getting older, and rental real estate doesn't really tend to change much from year to year. If anything, it's very stable, right? Real estate is a very safe investment. You've always heard it doesn't give you a lot of ROI, but it's also return on your investment, but it's very stable. It's very predictable as far as what it's going to do for you. It typically doesn't have too many issues. There might be some repairs here and there, but overall, it's kind of making the same thing, hopefully, right? We've heard of hard cases. Here in Freeman CPA, we work with real estate as an investment in many facets for many years, so we're quite familiar with different situations. But anyway, back to what's happening here is, as this person starts to age and their income starts to go up, they're going to start hitting this passive activity loss rule limitation of 150K. So what's going to happen when we reach that age? And I've actually had that happen with one of my buddies that's still doing taxes with me. We're pretty much the same age, and he was in the rental real estate game since back 2004, probably earlier, and he's always had different properties that they've been renting out. And as he aged, so he was making all these, he was saving in taxes, always getting a nice refund at the end of the year from overpayment of taxes. And as he started getting older, all of a sudden, somewhere along the line, he started making over that $150,000 mark, okay? And what ended up happening was, just one fine year, I think he bonused out and he ended up with over 150, and he got those losses suspended. And his tax bill came in and he actually owed money instead of refund. And he was like, what in the world happened? Well, buddy, you broke the 150K modified adjusted gross income, and we call that MAGI. I'm not going to go into like what MAGI calculations are, but you can just think of it as your AGI or your adjusted gross income, and this will be your modified adjusted gross income. Just think of it as income. Most people don't have many modifications, so there is really little to talk about. You can just think of it as gross income. You'll know if you're, you're making 150 or so K, you're pretty much at that 150K mark. And what ends up happening is then your passive activity loss rules kick in, and you get 0 deduction for your rental real estate activities. Whoops. And that's what happened to my friend. He started making more money, and he was like basically panicking. What do I do? What does this mean? And so on. And those are great questions. So again, unless you're a real estate professional. If you're a real estate professional, that's a different story. But if you're not a real estate professional and you've exceeded that limitation, and then what ends up happening is these losses are not lost. They're basically carried forward indefinitely. All right? And they get suspended on Form 8582. You don't need to really worry about it, but you should know that that's where they go, and that's where they're kept. That form keeps track of your losses year after year, and it keeps track of them as they compound and get suspended from one year to the next, and it keeps accumulating, and that form is keeping track of those losses indefinitely until one of three things happen. How do I free up those losses? Three things have to happen. One, my income goes down. Hopefully not, right? We only want our income to go up as we get older. Two, I have other passive income to offset losses, right? I have another investment, I have another rental real estate, or I have invested in a publicly traded partnership, and that's passive to me. That's two. Three, this is what happens. Three is what really happens to most people, is I sell the property. Okay, so let's talk about selling the property. That's the most common way. So when you sell this property, there's going to be multiple calculations that take place. This is not an easy thing to go through. This is what a skilled tax accountant that's been working in rental real estate for multiple years will understand how this has to happen. And for most people, this is going to, nobody knows how this will actually turn out for you in tax purposes, because there's so many moving parts. A lot will depend on the deal, how much you're selling this property for, what the story was with the property, how much you've invested over the years, and how many losses has been suspended over the years, if you're a real estate professional or not, if you've been absorbing those losses. So there's a lot of moving parts. So you could never say, oh, I'm going to sell the property and I'm going to lose money, or I'm going to make money, it's going to be a good year for me for taxes or a bad year. All I can tell you is that if the losses have been suspended because of passive activity loss rules over the years, they will be freed up in the year of sale. And then that's when you'll have multiple things happening. So selling the property, that's where the smoke and mirrors comes in, all right? And why is it so hard to tell? Because you're gonna have moving parts. Okay, you're gonna have capital gains tax exposure. Okay, at the year of sale. So all that depreciation will be recaptured. And it's the allowed or allowable. All right. So what is depreciation? That's that non-cash outflow that you have been deducting all this time, and it can be taxed up to 25%, currently under 2021. So wow, that's what I mean about smoke and mirrors. It was a deduction for you, all that sell it, you have to recapture it, and then it's subject to 25%. So if I depreciated for 7 years and I depreciated $10,000 per year and it's $70,000, I'm going to recapture that. No, it's not 75 times 25%. No, that's not how it works. It's not a flat rate. It's a complicated calculation, and there's moving parts, but it can be taxed partially up to 25%. That's depreciation recapture. And what does allowed or allowable mean? Well, some people try to do their own taxes and they didn't do the right amount of depreciation. They skipped on depreciation for some reason and just reported the rental income and expenses. I've seen that happen. And they should have been allowed a certain amount of depreciation per year. They have to take that into consideration when it's sold and recapture it anyway. Whether or not they took advantage of that depreciation over the years, it's too bad. That's a whole other story. There are ways around that nowadays to fix that. in the year of sale, but that's not easy. It's very complicated. It would be through Form 3115, change of accounting method. And that's just a separate topic altogether. That's highly complicated. So that's allowed or allowable. So whatever I was allowed, so even if I over depreciated, I still have to recapture that. If I was only allowed 70,000, but I took 80,000, I have to use 80,000 as what I took, and then that would be subject to my recapture. If I didn't take it and I was allowable 70,000, I only took 25, too bad, I have to take the 70. So that's depreciation recapture. The rest of the items would be subject to 1250 property rules, and that's regular capital gain, right? And capital gain could be anywhere from 0% to as high as 20% currently. So that's why it's hard to say exactly what that would look like, because the other ordinary capital gains really are determined by your income level. So it can be really low or it can be pretty high. And again, that's not a flat rate. People always hear 15%. That's the most common, but it's not 15% flat either. It's a long worksheet. It's a Schedule D worksheet that figures out capital gains. That thing is 2 pages long, and it's taking many it's many moving parts. There's a lot of different things that go into it. So it's never going to be like a flat rate. So that's basically what ends up happening at the year of sale, and that's why it's not very straightforward. Now, just keep in mind, land is not depreciable. So the value of the land is not depreciable. So when you're getting your closing, you make sure that you pull out the value of the land, because that's something that doesn't depreciate. Land only goes up in value. All right, so that's basically the gist of your passive activity loss rules, what it means for tax purposes, what a tax shelter is, what happens in the year of sale. That's pretty much the most common situations we see and how it all plays out for everybody. So, any questions? You guys know where to find us. We're here all day, every day, making sure that your success is our success here at Freeman CPA. Have a great day.